Washington, D.C.'s Bridge District is quickly emerging as a model opportunity zone project, showing how OZ capital can drive long-term transformative impact in one of the most underserved parts of the nation's capital. Welcome to the Opportunity Zones podcast. I'm Jimmy Atkins, and joining me on the show today are Jeff Tompkins of Altus Capital and Sohael Chowfla of Redbrick LMD. Gentlemen, welcome to the show. Great to see both of you today.
Thanks, Jimmy. It's great to be here.
Good morning, Jimmy. Thanks for having me.
Good morning to you both. Jeff, I'm going to start with you first. I'm sure you and your team at Altus Capital have been tracking the progression of OZ legislation throughout the spring and summer, and then the One Big Beautiful Bill Act was officially signed into law on the 4th of July of this year, 2025, and now OZ 2.0 is a reality. It takes full effect January 1, 2027. Opportunity zones are now a permanent part of the tax code. What excites you the most about this new OZ 2.0 legislation and its implications for your long-term opportunity zone investment strategies?
Well, to call the One Big Beautiful Bill Act a nail biter would be an understatement. I think we're all kind of on the edge of our chairs here, watching some of those final changes come through in reconciliation, and finally the bill on the president's desk. And, you know, the One Big Beautiful Bill Act, or as I like to call it, UBBA, has really done some very profound things for our industry, particularly in making the Opportunity Zone program permanent. This allows for multi-generational long-term investment strategies that should attract new classes of capital. I think it gives permanence and visibility and a sense of trust for investors coming into the program for the first time. And then I think as well, it does some really interesting things to the existing OZ program relative to the new legislation coming in 2027. That is to say, there have been the shifts, the changes to the program have really kind of changed the game in terms of the near-term opportunities for existing OZ sponsors and developers. And then create some interesting challenges and opportunities as we look into 2027.
So what are some of those challenges and opportunities? What might be the most significant challenges that you think OZ developers and investors might face under the OZ 2.0 program, especially in that first year?
Yeah, well, it's interesting, right? Because we have this kind of gap period between now and Jan 1, 2027, when the new program comes into place. We have the new 5-year rolling deferrals. And we get asked by a lot of investors, what should I do? How should I think about this? And it's kind of a difficult question to answer, because on the one hand, you have the attractive 5-year deferral, right, for new OZ investments that are made starting in 2027. On the other hand, and Sohael, I suspect you'll talk about this because it's particularly acute in DC. But on the other hand, you have this confluence of a very acute shortage of multifamily housing. So market forces which are driving up rents, right, driving down vacancies, and a confluence with this legislation, which creates a very unique near-term opportunity for investors to jump into the OZ1 program, that if you sit in the sidelines and wait for new starts coming in 2027, you could potentially miss. So it's this interesting conversation of, if I have gains now, what should I do? Should I invest now into the OZ1 program? Should I be thinking about OZ2? And the answer is not that clear. I think it depends on your market. And some of the specific markets we've chosen that are very acutely experiencing the shortage of housing, had very few starts in the past couple years, are really going to have this sort of perfect storm or perfect opportunity, if you will, in the next couple years. Those are the types of sponsors and markets that we've been looking to partner with in our current fund. Yep.
Good. And let's dive into that a little bit more, drill into what's happening with multifamily a little bit more. Jeff, your fund at Altus Capital, you're invested in a few different markets around the country, but today we're focusing primarily on Washington, D.C. So first, let's talk about, and I'll ask you, how would you characterize the current multifamily market nationally right now? What's happening with new starts? What's happening with rent growth? What's happening with cap rates? And then specifically in Washington, D.C., what's happening with multifamily?
Yeah, so I'll let our expert Sohael talk specifically about the DC market because I know that Redbrick has been following that probably more closely than most. But I will say nationally, what we're seeing is while there's some signs of sort of moderation in multifamily housing starting to slow down, vacancy rates still expected to be in the sixes, in the low sixes for early 2025. And estimates have it kind of settling down by around 6% by year's end. And I think the DC market is in stark contrast to that. And then additionally, when we look at the pace of rent increases, national rent growth projected to be sort of 2.5% for 2025. And I suspect that DC is going to see a significantly larger rental income growth. In fact, I saw a headline, Sale, not to do a spoiler alert here, but saw a headline that described the next 2 years, 2026 to 2028, as the year of the landlord for DC. If that's any indication, Jimmy, of what to expect in that market.
Yeah, definitely. Well, let's turn over to Sohail right now. Sohail, I'll bring you in. Can you tell us a little bit more about that headline that Jeff just referenced and what's going on in particular in Washington, D.C. with regards to multifamily?
Yeah, absolutely. First, just a bit about Redbrick for those that don't know. We're an owner, operator, developer, vertically integrated, sponsor focused primarily in Washington, D.C. We're actually one of the largest private landowners in Washington, D.C., and we own and control an approximate 6 million square foot pipeline in D.C. and have delivered over 1,500 apartments very recently in DC. We're experts in DC and we're primarily focused in multifamily. So I would, consider us experts in that arena as well. And we've been tracking supply macro trends in DC, demand trends for the past 2 decades. And what we see when we look forward to the supply landscape in DC is very low new supply beginning in 2026 and really over the next several years. The combination of the rise in interest rates that began 3 years ago, along with the sharp increase in construction costs that we saw again due to inflation over the past 2 or 3 years, has led to a very low number of starts in the market. And the good news too is that we're beginning to see some softening in the construction cost market. So we're beginning to see costs come down as some of those contractors and subcontractors begin to get hungry. But really, when you look out into the horizon in DC, 3, 4, 5 years ago, you would have seen over a dozen cranes out there, maybe even 2 dozen. Today, there are very few. You can count them on one hand. And usually that is the best time to invest in commercial real estate because no one is building, and that allows you to deliver into a very tight supplied market. When we look at sort of the supply going forward, we also are looking at permit data to help inform where we think things are going. Almost no building permits have been filed for high-rise multifamily buildings this past year. In fact, only 3 building permits were issued for multifamily buildings in all of 2024. And only 1 building permit was issued the first half of 2025. So when we look out at the forecast, we're looking at fewer than 1,000 multifamily units being delivered in DC per year for the next 2 years. And then really it falls off a cliff, Jimmy. There's nothing out there in 2028, and hence the years of the landlord, right? When you look back over the past 10 years, just to put that in context, that 1,000 units for the next year or two in context, DC has delivered 3,000 to 4,000 units per year over the last 10 years. And those units have absorbed. So the market has been in equilibrium. Now that you look out and see that there's such little supply coming onto the pipeline, we think that there's an opportunity, especially when you look at the basic fundamental macroeconomics and demos in DC. DC is one of the wealthiest metro areas in the United States. But what DC also has is a relatively low income rent to income ratio. And what I mean by that is that DC is an affordable city. In most major metros, people are spending 30, 40% of their income on rent. In DC, that number is closer to 15 to 20%. And DC has very high median household income. It's actually the second highest median household income market, only after San Francisco. San Francisco is about $128,000 median income. DC's second at 117. But DC's rent to income ratio is much better than San Francisco. So the combination of that tight supply that we see over the next 2, 3, 4 years and the ability for DC renters to effectively pay more as a percentage of their income will allow landlords to organically increase rents such that the rent to income ratio comes more in line with other major gateway markets. And that provides tailwinds for us to be developing and building to core high quality product that renters will want to pay for. So very interested, obviously very bullish in DC, very interested to track developments over the next couple of years. And that's why we're building into this market.
Yeah, some major structural tailwinds for developers in that area over the next few years. It sounds like, Jeff, turning back to you, we got the broader national landscape of multifamily. So Hale just told us a little bit about what's happening locally in the Washington, D.C. market. A specific subtype of multifamily that your fund focuses on is workforce housing. What do you like about workforce housing right now, and what makes DC in particular especially attractive for that type of housing?
Yeah, I think we like markets where we see a dearth of supply and workforce housing relative to commercial development. So in Austin, it's the new Tesla Gigafactory, the Speedway, and some other commercial developments that are fueling demand for multifamily housing adjacent. Similarly in Charlotte. And DC is interesting, right? Because you have recession-resistant, reliable workforce demands, right, from the largest employer, the federal government, and you see growth in other industry sectors in DC, which is driving that demand as well. So, Hale, I'll let you speak to the specifics because I'm sure you've got a much clearer view into what those dynamics exactly look like. But I think, Jimmy, it's safe to say that on the workforce side of things, our thesis is that markets where there are some of these tailwind dynamics that Sohael is describing, combined with concurrent opportunities in workforce demand, that's the real sweet spot for us. There's some other stuff that's interesting, maybe we can talk about later with regard to OZ2 and dynamics around the role requirements. But I think to directly answer this question now, that's what we're seeing in terms of specific markets with regard to workforce.
Good. So, Hale, any follow up there?
Yeah, DC is an interesting city because it used to be a government town. About 30 years ago, 75% government employment, 25% private sector. That equation has now flip-flopped, and DC is actually a 3/4 private sector town and 25% government town, and not very many people know that. And that has allowed incomes to rise, and it's a highly educated city as well. So there's a very discerning consumer here in terms of the housing market. It is also a very supply constrained market. There is an artificial supply cap in this city. It is height limited to 130 feet. And so there just really isn't that much supply existing in DC. And as we know, home values have gone up dramatically over the pandemic. And DC has witnessed significant home value increase. And it's actually pricing a lot of buyers or would-be buyers out of the market of purchasing homes in DC, many of which are historic and really, are limited again in supply. And that again is a tailwind, as Jeff mentioned. There are so many tailwinds for DC. Another tailwind for DC is simply this highly educated, high income market that wants to move into a home, can't afford to because their either isn't enough inventory or they're priced out of it, but is discerning. And so they want a rental product that is built to modern, high quality standards in well located areas. And our project at the Bridge District is a perfect example of that.
Yeah, let's zoom in on the Bridge District now. So, Hale, first of all, where is it? Maybe you can paint us a picture of where it is in Washington D.C. relative to some other familiar landmarks. And what are you building there exactly?
Uh, Jimmy, the best way for me to paint a picture is to pull up a picture. So I'm going to just pull up one slide, and I know many of your listeners are, podcast listeners over audio. So, I would love to follow up with anyone that has further questions, and I can give you my detailed information on how to get me. But here up on screen, I have a rendering of the Bridge District. The Bridge District is a new neighborhood that's comprised of 8 acres and 2.5 million square feet of fully entitled land located in an OZ, approximately 1.5 miles from the US Capitol and directly across the river from the Washington Nationals baseball stadium. It was formerly vacant land in really the most underserved part of DC, and it is now bringing housing, jobs, neighborhood amenities, and all of these things that the community is really seeking. And this area, which is Ward 7, Ward 8 in Washington, D.C., has a population of about 160,000 people, but it has not one hotel and only 3 grocery restaurants and 2 sit-down restaurants. And so we are bringing a significant amount of development, economic development, growth to this part of the city. But at the same time, because of its location, it's right there. It's just 1.5 miles from the Capitol. It's right across the river from Nats ballpark. And its location is next to a 100-acre national park. The river bends around it, so you enjoy sweeping views from the Bridge District. And the buildings are built to full 130-foot height. And so really the views are spectacular. They say the best view of New York City is from Jersey. And this is really no different. And I think that picture says it all. The view from the Bridge District off DC and its monuments is bar none. I'm going to stop sharing here. There's a few different phases of the Bridge District. The first phase we delivered earlier this year. It's 3 buildings comprising 757 units. We began construction on that in 2022 and delivered it in Q1 of 2025. We funded it with $225 million of OZ equity, which was raised from 2020 through 2022. So it's a very large OZ project, and it's right here in the nation's capital and really is a showcase next to where all of the folks writing the bills and laws for our country come to work every day. 2 of the towers are long-term rentals, i.e. 12 to 14 month minimum leases. And then 1 tower will be a short-term rental that's comprised of smaller units, and it'll convert to full-time long-term rental upon further lease up of the buildings. There's 24,000 square feet of retail on the ground floor, including 2 restaurants, a brew pub from a beloved local brewery called Atlas Brewworks, coffee and wine bar, and a small market. The second phase will be a 300-unit multifamily building, which we'll be commencing construction on later this year. We have raised all the OZ equity in for that project. The third phase will be 600 multifamily units that should start construction next year. And that will also be capitalized with OZ equity.
Excellent. So it sounds like you're building. Well, what's the total amount of residential units that you're building? I lost track there.
2,000 units. And
over 2,000 units. 2,000 units. Wow.
2,000 units, delivered 750, 300 starting later this year, and then 600 next year. So really gaining momentum on the build out of the neighborhood.
And with regards to the first phase, how's lease up going there, and any insights into who's moving in and what kind of demand you're seeing for that first phase?
Jimmy, I'm glad you asked. Lease up is going tremendous. It's exceeding our expectations. And I think partly due to the lack of supply in the market, and also just, I'm a little bit biased here, but the product as well. We're currently at about 1/3 of the units leased. Average rents are over $4 per square foot and on par with rental rates at buildings in the surrounding area, including across the river. The building, just to put a finer point on it, is 88% market rate and 12% affordable workforce housing. So think, first responders, teachers, firefighters, nurses, etc. Really providing a spectrum of housing types for society. So you've got market rate, you've got short-term rental, you've got affordable workforce housing. Really, the Bridge District is a melting pot of DC, and we want to bring everyone in the city together into this neighborhood.
When you say affordable, are you talking about subsidized capital A affordable, or is it structured a little bit differently than that?
Glad you asked. It is not subsidized capital A affordable. It is what's called inclusionary zoning. And so DC has an inclusionary zoning program, and that allows for people who cannot afford a market rate unit to still live in a building that has all the amenities and characteristics and qualities of a market rate unit by creating lower rent unit types within the building as part of the zoning envelope. And so we rezoned the site for full max height density. And as part of that arrangement with the city, we have set aside 12% of the units as affordable with a lowercase a, inclusionary zoning units. And really something the community really wanted to see here was family-sized housing. So family-sized attainable housing. And so we are actually including 50% of our affordable unit mix in this building as 3-bedroom unit types. Most multifamily rental housing today does not have new construction 3-bedroom unit types in it. It's just not something the market's building. And so we were able to respond to a community need by including that. The short-term rentals are also doing very well. It really is a testament to the demand in this location. It's adjacent to several government installations, including Joint Base Anacostia Bowling, the Defense Intelligence Agency, White House Communications Center, Homeland Security, and then ICE, DHS are building a headquarters here, in addition to many local DC government offices as well. And that's really providing a lift for short-term rental housing, especially when combined with the return to in-office mandate, which I'll get into later as well.
Okay, good. So really cool project. It sounds like you worked with the community to deliver what the community wants. They made sure that you set aside a certain portion of the units as attainable or affordable workforce housing. What about the fact that it is an opportunity zone project? How has the OZ structure of it, or the fact that it is OZ property, helped shape your strategy and help get this thing financed and built faster than it might have otherwise?
It was a huge component of getting the building capitalized, right? The OZ designation for the land and the property allowed us to raise capital at a quicker pace. It allowed us to deliver benefits to the neighborhood and community faster. We were able to build hundreds of units of housing, including attainable workforce housing, at a time when it was hard to capitalize projects. So a huge component of the cap stack is OZ. And then we were able to think long term. OZ is a 10-year hold. And so we were allowed to think what would happen mid-2030s in this market in DC that we should be thinking about, so that we can create value for our investors and retain value for our investors and enable our investors to have the best outcome when they exit in 10 years. So outside of all the tax benefits, et cetera, which are incredible, and Jeff could go into that some more, but we want to make sure that we are putting investors first. And so what we did to future-proof our buildings is we figured out how to build them to carbon net zero standards at no discernible premium in cost. And we did that not because we love the environment or we're tree huggers or anything like that. We did it because we're capitalists, and we did it because we think it protects investor value. There is a carbon tax that exists in many jurisdictions across the United States: New York, Seattle, San Francisco all have versions of one. And DC has one in the works too, and it's actually in place in some respects. And it's only going to get more punitive to building owners and developers that have quote unquote dirty buildings. So they will either be subject to very expensive retrofits to come into compliance, or they'll be subject to hefty penalties in the form of an actual annual tax, or a combination of both. All of these things are going to come together to impact NOI, net operating income at properties, and impact valuation of buildings. And so we saw that coming, and we saw the OZ 10-year hold as a way to build for 10 years out, build for the future. So that building I described that's actually built today, phase one of the Bridge District, it is the largest multifamily building in the world to seek ILFI zero carbon certification. And all the future phases of the Bridge District are anticipated to be constructed to achieve this certification as well. And we can do this at no discernible cost premium, protect investor values, and actually accrete to lease up and rental rates by doing it this way. So that is one thing that OZ was really, interestingly, a key component of. And a few stats. The building that's built today has 36% less embodied carbon than the average building in DC that is built of concrete. This isn't built of anything magical, it's concrete. It's 36%. And when we go into the operational phase, we anticipate reducing that carbon emission number by 40 to 45% because the building is built very efficiently. It's energy efficient systems, it's a tight envelope, and all of that falls to the bottom line, right? Lower utility bills fall to the bottom line. It drives NOI higher. It contributes to, we think, higher value at exit because of a lower residual. We also think it can accrete to cap rate, to lease up. Atlas Brewworks, the brewery I mentioned, Jimmy, they're a solar powered brewer. So when they were introduced to us, it was like an aha, of course we must partner together because they do solar powered beer. We're building a net zero building. And we were able to sign up a 25,000 square foot anchor tenant in the building pre-leased before we even put a shovel in the ground. That is very hard to do in the retail world, to pre-lease that much retail. And so fundamentally, we believe strategy focused on decarbonization is accretive to value. And we're going to drive value through this process for our investors. And I'm going to show one more quick slide because I would like to share a QR code with your viewers. And if they can take a scan of this QR code, they will be taken to a website that has a white paper that Redbrick wrote. It's our Decarbonization as a Business Strategy white paper. And it outlines our approach to net zero carbon buildings. And it allows investors to better understand, or just people who are listening to our podcast to better understand how we think decarbonization is accretive to value. And I'll send that QR code to you as well as a follow-up.
Perfect. Thank you. And yeah, the decarbonization and the whole green building initiative that you're undergoing, again, not because you're tree huggers or you love the environment. That's beside the point, right? It's because you're capitalists. And I love it. And I think part of what you were, or what I've inferred from what you've said, Sohael, is that under an ordinary structure where your holding period might only be a few years, or maybe you would just get it developed and then sell the property off after a couple of years, maybe you wouldn't necessarily be incentivized to focus on the long-term net zero decarbonization green initiative attributes that you just went into. But because you and your investors are required to hold this property for 10 plus years, it gets you thinking more long-term. Is that part of, is that correct there?
That's exactly right. It's a
Good.
perfect summary.
Good. Yeah. And so what are some of the, you spoke, we don't need to belabor this too long, but I'm just kind of curious, what makes a building green? What makes it a net zero carbon? Is it, you talked a little bit about the building materials, it's just concrete, it's got a tight envelope, but are there solar panels? Is it something else with the efficiency, or what is it that makes a building green and is able to get that certification that you're seeking?
Yeah, real quick. And the white paper has all the details, so I'll keep it high level.
Okay.
net zero means getting to zero carbon. And so building is inherently going to be carbon creative, right? Creates carbon offsets. So the first thing we do is we build with concrete that is low carbon. So a typical building has, 3 or 4 or 5 concrete mixes as you go up the building. Our building has over 20. And as the building gets lighter, effectively, as you go up to the top of the building, we have less cement in the building because it's holding up less weight. That is a very simple thing that we did to reduce carbon. So that made our deficit lower. And then to get to zero, we used tight envelope, highly efficient mechanical systems. And then what's really interesting is that we created a building-wide circulation loop with the retail. So the brewery produces a lot of excess heat. We were able to capture that heat and recirculate it to the apartments so that when they turn on their taps for hot water, or they need to do a heat exchange for their air conditioning systems, they don't have to lift the water temperature as much. It's so simple, right? We just created a big circ loop throughout the entire building. And then we did all the traditional things that you associate with green building as well. So there are solar panels on the building. There are EV charging stations in the building, of course. But the secret sauce is really unique concrete mix, tight envelope, efficient HVAC systems with a recirc loop for this building. Every building is unique though, and the next building might have different techniques to get there.
Good. Well, let's shift gears to DC more broadly. DC has been making some headlines here in recent weeks. We're recording this in the middle of August, and the National Guard has just been deployed to DC to crack down on crime, I suppose. What are you seeing on the ground in DC? Has there been a huge surge in crime lately, or how would you characterize what's happening in Washington, DC right now?
Yeah, it's interesting. I think the headlines are mixed. Let's start with policing. Crime peaked in DC in 2023, and it's been on a decline since, right? Largely because arrests, prosecution rates are much higher, and overall crime is actually down 20% year over year. And violent crime, which is the thing that you want to watch out for, is down 35% from 2023 to 2024. And is really down an additional 26% year to date. DC actually has the highest per capita police per resident ratio of all cities in the US. But that being said, I mean, crime is higher than we would like it to be. I mean, obviously I would want my kids to be feeling safe when they go out on the street, or my, older grown children. But it's also important to note that large swaths of DC are owned and patrolled by the federal government. So while we have DC MPD patrolling the streets, we have federal government patrolling the streets. So the narrative that you see in the media about the National Guard coming to the city, and additional agents, federal agents being brought to the city, in some ways is something DC has always been used to. But what it's allowing the city to do is to have better coordination between federal police that has always been in DC, because so much of DC is federally owned, and better coordination with DC MPD. And that we are hugely in favor of, because why wouldn't we want there to be a safer city for our residents and our visitors? And so we think that it's a great thing. We think that this coordination that's going to occur, this additional force that's on the street, is a good thing for DC.
Good. Nothing, nothing wrong about cracking down on crime where you can, and making the streets a little bit safer. That's my point of view anyway. Well, let's get back to Jeff now. Jeff, I want to bring you back in. We heard from Sohael for a while about DC's Bridge District, what's happening there locally with multifamily markets and with crime and other economic trends, and specifically with regards to the project that Redbrick is developing there. How does this Redbrick project fit into Altus Capital's overall strategy? Maybe you can speak a little bit about your broader investment strategy and your multi-asset fund.
Yeah, thanks, Jimmy. And Sohael, I really enjoyed hearing about that. Yeah, I think, Altus is a national diversified multifamily opportunity zone fund. So we diversify across geography and also across our different sponsor developer partners. And I think what I was reflecting on as I was listening to Sohail share a little bit about Bridge District, and we were down there, by the way, Jimmy, a couple months ago for a site visit and got to go up to the roof and look north to DC, and the views are spectacular. Although I'm recording live here in Rockefeller Plaza in Midtown New York, so we might have to compare views, but Sahel is right. The view from outside New York is arguably better than from in the center. Um, yeah, I think what Sahel described really is why Altus chose Redbrick as a partner in both of our funds. We're investing out of Vintage Fund 2. Um, when we think about a partner, we're looking at a partner that is not just future-proofing the investment for investors, but also looking creative at ways to align the incentives of capitalism with buildings that also can be sustainable in some ways. And I think the report that Sahel's referencing is first in its class. It is truly an exceptional report, and it's exciting, the designation that Bridge District is looking for. So that's kind of how we think about the different partners that we work with. Jimmy, we look for development of new Class A properties, intention to hold them long term, income producing rather than merchant building for quick sale or stabilization. And the DC market in particular, in the next 3 years, given that it's essentially a quintessential landlord's market, we're excited about all the things that Sahel mentioned: rapid lease up, premium rents, superior net operating income, or as Sohail described it, net operating impact, and valuation. These are, all great reasons we think that Redbrick is one of the largest OZ land holders in DC, is a great partner for us. And then there's this interesting piece of the new OZ legislation, Jimmy, which is the rural or agricultural emphasis on trying to bring investment to more rural areas. Just a quick note on that, since we foreshadowed it kind of at the start of our recording, is that we think that this rural requirement is going to make companies like Redbrick in an even more advantageous position in terms of their competitive positioning. That is to say, companies that already have access to existing well-located urban qualified opportunity zones, particularly those in markets with strong underlying fundamentals. And in this case, Redbrick is a great example with their waterfront parcels in DC. We think developers who already control these prime QOZ land sites now hold an even more valuable and defensible asset moving forward. So it's just interesting to see kind of how these shifts are taking place as the new program comes into effect. But we think that when we're looking at partners to work with, those with existing QOZ designated plots that are shovel ready or already under development, are really well positioned to capitalize on some of those tailwinds and market forces and dynamics coming in the next few years.
Absolutely. Well said, Jeff. Gentlemen, we're just about out of time. Really appreciate getting insights from both of you today. Before we go, if we have anybody in the audience who's interested in learning more about either one of your organizations, so Hale, I'll turn to you first. Where can our audience go to learn more about you and Redbrick LMD?
Yeah, absolutely. Jimmy, it's been a pleasure being here. Thanks very much. And anyone in the audience wants to learn more, they can go to our website, www.redbricklmd.com. And they could also email us at SCHOWFLA, that's my name, Sohail Chowfla, Chowfla at redbricklmd.com.
Perfect. And Jeff, turning to you now, where can our audience go to learn more about you and Altus Capital?
Thanks, Jimmy. This is from OZ Day, so well positioned for this moment in the podcast. Altus Capital, ALTES, capital.com is our website, and you can reach me, jeff.tompkins at altuscapital.com. If you're looking up on your screen, you can see some additional contact information here, but the website is a good place to reach us. And of course, Jimmy, opportunityzones.com, because your listings and your catalog of previous recordings of OZ Day participants and folks in your community is a great and easy way to find out more information. And there's that Altus Insight reports that I referenced. So if you'd be interested in learning more about what we found, which is the true benefit of the OZ program is in the long-term hold and the tax benefits as opposed to the short-term capital gain deferral, we'd be happy to send you a copy of that as well.
That's perfect. And thanks for the opportunityzones.com plug. We've got a big marketplace of a lot of different opportunity zone deals and funds listed on our platform there. And Altus Capital is one of our best partners and sponsors of our event series, OZ Pitch Day. So Jeff and Sohael, thanks for joining me today. For our listeners and viewers out there, if you enjoyed today's episode, hit that like button, give us a thumbs up. We're going to have show notes available for today's episode at opportunityzones.com/podcast. There you can find links to all of the resources that Sohael, Jeff, and I discussed on today's show. Please be sure also to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. Gentlemen, again, thanks for joining me today so much. It's been a pleasure.
Thanks, Jimmy.
Thank you, Jimmy. Pleasure. Take care.